If you're an investor in Far East Hospitality Trust, you've probably seen the headlines about Singapore's tourism recovery. Tourists are flooding back, hitting 91% of pre-pandemic levels. But then you looked at your portfolio and you saw FEHT's numbers. You saw their core Singapore hotel revenue per available room drop 5.4% in the third quarter. You saw their serviced residence revenue drop 3.0%. And you're probably asking yourself, if tourism's recovering, why is my dividend stock stumbling? But if you're just looking at that Singapore headline, you are missing the real story. This is a complex tale of two markets. What the headlines missed is the new growth engine that's just starting to fire up in Japan, which saw its own revenue jump over 13%. They also missed the single most important part of this REIT, its rock-solid balance sheet. This isn't a simple tourism is back story. This is a story of diversification, balance sheet defense, and a core market that is facing real headwinds. And we need to break down if the 5.9% dividend yield is a reward for patience, or if it's a trap. I'm Iggy, your Singapore-based market analyst, and my job is to cut through the noise and show you what really matters for your CPF, SRS, and SGX portfolios. And we've been putting in the work. Since October 2025, this channel has produced over 200 videos with more than 600,000 watch hours. We were also honored to be ranked 8th in Tiger Broker's 2024 Influential Tigers. My focus is always on regional and global trends to give you that broader context, so you can uncover hidden gems and potential pitfalls. Today, we're going to do exactly that, with a deep dive, slide by slide, through Far East Hospitality Trust Q3 2025 business update. All right, let's get into the presentation. The first thing we need to tackle is the core problem. The Singapore market is stumbling, even as tourists return. Let's start with slides 6 and 7 on Singapore hotel performance. This is the reality check. We're looking at a few key metrics. Occupancy, which is how many rooms are full. Average daily rate, or ADR, which is the average price paid per room. And the most important one, revenue per available room, or RevPAR. You get RevPAR by multiplying occupancy and ADR. This is the core engine of a hotel's profitability. Now look at the numbers. RevPAR for their Singapore hotels fell 5.4% in Q3. The year-to-date number is also down 5.2% to $138. Why? It's a double whammy. The report mentions the Formula One race shifting to October, which pulled high-rate business out of Q3. But the broader story, the year-to-date story, is that ADRs are down 4.8%. This tells us they are facing intense competition. For us, as Singapore investors, this is the headwind we've been warning about. First, you have a flood of new hotel supply coming online. Second, you have a very strong Singapore dollar, which makes us more expensive for budget travelers from Malaysia, Indonesia, or Australia. So while the number of tourists is up, as we see on slides 15 and 16, they're staying for shorter periods, 3.5 days versus 3.64. And hotels are having to fight on price to fill rooms. This puts direct pressure on margins. And this weakness isn't just in hotels. Let's look at slides 9 and 10 on service residences. This is the segment that's supposed to be more stable, targeting long-stay corporate clients. Here we look at revenue per available unit, or RevPAU. Same idea as RevPAR. And the story is, unfortunately, the same. Year-to-date, RevPAU is down 5.2% to $220. Occupancy fell by almost 5 percentage points. The trust points to construction near one property, but the real issue, as they note, is softer corporate demand. Slide 11 confirms this, showing corporate travelers now make up only 28% of hotel revenue, while leisure dominates at 71.9%. This is a direct reflection of Singapore's slowing economy. When multinational companies cut costs, the first things to go are business travel and expensive relocation packages. This segment is supposed to be the stable anchor, but it's stumbling right alongside the tourist-focused hotels. So with the core Singapore market, which makes up the vast majority of its income, getting squeezed, you'd think this is an easy sell, right? Not so fast. This brings us to the bull case, which isn't about operations at all. It's about the balance sheet. Let's turn to slide 5, balance sheet strength. This is a genuine bright spot, and for many investors, the main reason to even consider this REIT. We're looking at the aggregate leverage, or gearing. This is simply the REIT's total debt divided by its total assets. The MAS limit is 50%, A lower number means less risk. FEHT's gearing is just 33.7%. This is one of the lowest and most conservative in the entire Singapore REIT sector. Their average cost of debt is manageable at 3.2%, and crucially, 65% of the debt is at a fixed rate. This means they are protected from most of the interest rate volatility. Their interest coverage is a healthy 3.3 times. For us as CPF or SRS investors looking for stability, this is exactly what you want to see. This balance sheet is a fortress. It means management is not in a panic. They don't have to sell assets at a bad price. They won't face covenant breaches. And the data shows a 25 basis point rate hike only impacts distributable income by $0.7 million. That is tiny. This conservative structure is what buys them time. It gives them the breathing room to fix the operational side, to continue their asset enhancements on slides 13 and 14, and to make their next move. Which brings us to the growth gamble, Japan. If Singapore is the slow and steady but currently struggling parent, Japan is the new exciting growth story. Let's look at slide 3 and slide 8. In April 2025, FEHT acquired the 4 Points by Sheraton in Nagoya, Japan. This is their first pivot outside of Singapore, and the initial numbers are strong. Slide 8 shows the Japan hotel's RevPAR surged 13.5% year-on-year to over 8,400 yen. The gross operating profit jumped an incredible 27.2%. This is the growth that is completely missing from the Singapore portfolio. The gross operating profit. Why is this happening? It's the mirror opposite of Singapore's problem. Japan's tourism is booming, driven by a weak yen that makes it incredibly attractive for international visitors. This hotel is also smartly positioned near Chubu International Airport, giving it a defensive base of airline crews and transit passengers. This is a very smart strategic move. It gives them geographic diversification and exposure to a market with completely different, and currently better, fundamentals. But, and this is a big but, let's look at slide 3 again. This one Japan hotel currently makes up only 5.2% of the total revenue. It's a great story, but it's just not big enough yet to offset the weakness from the other 80% of the portfolio in Singapore. One hotel doesn't make a diversification strategy. It's a good start, but they need more of this, and fast. So this is the core conflict: a weak home market, a fortress balance sheet, and a tiny new growth engine. This all leads us to slide 4, and the number everyone cares about: the 5.9% dividend yield. Management highlights this 5.9% yield, which is based on their first half 2025 distribution. And it looks very attractive compared to a Singapore savings bond at 1.8% or even the STI index at 4.8%. But for us, yield without sustainability is a trap. The key question is, can they maintain this payout while their core net property income is falling? The strong balance sheet and 3.3x interest coverage ratio give them a buffer. They can probably maintain it for now. But this is not a growth dividend. You are being paid this 5.9% to wait. You are being paid to weather the storm in Singapore and wait for management to either fix the local operations or, more likely, buy more properties in Japan. This yield isn't a trap, but it's not a no-brainer either. It's compensation for taking on the operational risk. Looking ahead, the road is mixed. Slide 19 shows a packed Q4 2025 events calendar with Formula One, Blackpink, and Christmas events, which should provide a near-term boost. And slides 17 and 18 show long-term positives with new attractions like Minion Land and the Singapore Oceanarium, which should help lengthen visitor stays. But slide 20, the macro outlook, reminds us that global growth is slow and the strong Sing dollar isn't going away. All right, we've gone through the slides, we've cut through the noise. So what's Iggy's assessment? Let's break it down. First, what's working? The balance sheet is a fortress. At 33.7% gearing, this REIT is built to survive. Management is conservative, and that's protecting unit holders from financial distress. Second, the Japan diversification is the right move. The first acquisition is a success, with a 13.5% jump in RevPAR. This is the new growth engine, even if it's small. Now, what's not working? The core Singapore market is the key problem. Net property income is falling. Both hotels and serviced residences are seeing softer demand and pricing pressure from new supply and a strong Sing dollar. One hotel in Japan is not enough to offset this weakness. This is the main drag on the entire trust. This brings us to valuation. The 5.9% yield is attractive, but it comes with near zero growth prospects in the short term. You are essentially collecting a dividend while you wait for the Singapore market to turn around or for management to make more growth-oriented acquisitions. So here's my final recommendation. It's clear, and I've split it into two parts. For existing unit holders, my stance is hold. You are being paid a decent 5.9% yield to wait, and your capital is protected by that fortress balance sheet. The dividend looks sustainable for now. There is no reason to sell in a panic, but do not expect much capital appreciation. Your job is to monitor their next acquisition. Do they buy more in Japan, or do they try to double down in the weak Singapore market? For new buyers, or those of us looking to allocate our CPF or SRS funds, I would wait. The risk-reward just isn't compelling enough for me right now. That 5.9% yield is nice, but you are buying into a portfolio with declining operational performance. I would rather wait for a better entry price, or for clear signs that the Singapore hospitality market has bottomed out. There are other REITs in the industrial or data center space that offer similar yields with much clearer growth runways. For FEHT, I am on the sidelines for now. If you found this valuable and want this kind of in-depth, no-noise analysis for your portfolio, consider becoming a free or paid subscriber to my Substack newsletter. You'll be in good company. The Investing Iguana has now hit over 1.3 million reads with 65,000 likes across our platforms. We're also thrilled to welcome our growing community of over 30 YouTube Premium subscribers and 15 paid Substack members who make this in-depth, independent research possible. Thanks for watching, and I'll see you in the next analysis.